Welcome back to the deep dive. We're digging into 2025 today, a year that, on paper, looked fantastic. S&P 500 up 16%, NASDAQ up 20%. A roaring bull market, right? But if you actually lived through it, you know it was, well, it was a roller coaster. Our mission today is to unpack that. We're going to get into the real story behind the Fed's sudden pivot, figure out how much of this growth was just the AI engine, and what hidden risks started bubbling up for 2026.
That's the core tension right there. The massive gains versus that extreme volatility. That's the signal we need to decode. We're looking at the surprising policy shifts, especially from the Fed, and the structural risks that your source material lays out so clearly. And of course, before we jump in, just a quick reminder, everything we talk about here is based on public information. It's for educational purposes, and it is definitely not investment advice. But on that note, if you are trying to track the market's overall temperature, we do encourage you to search and download the iOS app Buffett Indicator from the Apple App Store. It's a pretty useful tool.
Okay, let's unpack this. The biggest shock of the year, I think, has to be the Fed. The market went into the year expecting, maybe one rate cut?
Maybe one. And instead, we got this incredibly sharp contrast. The Fed cut rates 3 times in just 6 months, September, October, and December. It was a sustained, aggressive pivot that just forced everyone to rethink the entire game plan.
Right, and the Fed is always trying to walk this tightrope, isn't it? Maximum employment on one side and stable inflation on the other. That's their dual mandate.
It is, and for these cuts to be so aggressive, one of those goals must have been flashing some serious warning signs.
And it wasn't inflation.
No, that's the critical part. Inflation was still sticky. It was floating between, say, 2.5 and 3%, which is still above their 2% target. But the Fed seemed okay to tolerate it. These 3 cuts were almost entirely driven by this wolf is coming story around employment. A preemptive strike. You see it with the September cut. They called it a preventative cut because unemployment had already ticked up to 4.4%. The message was, we're not in a catastrophe now, but we're trying to prevent one.
And then the October decision, that was just extraordinary. It happened during a government shutdown, which means the main data they rely on, the big payroll reports from the Bureau of Labor Statistics, it just wasn't there.
Exactly. The sources called it a blind flight.
A blind flight. So they were making a huge decision with no data.
No primary data. And that immediately just fueled speculation that the weakness was already so obvious, or maybe the political pressure was so intense that they had to act anyway. It turned policy into a real gamble.
So if they couldn't see the big government numbers, what were they looking at? What were those other signals they were picking up on during this blind flight?
Well, they were relying on alternatives and revisions. So first you have the ADP data, the small payroll numbers from the private sector. That was showing weakness. But the more alarming thing was a historical revision.
Ah, right.
The Bureau of Labor Statistics had to issue this significant historical downward revision for job growth in the months before all this.
So they were basically admitting that the job market had been much weaker than the headlines were telling us all along.
Precisely. It confirmed that bad feeling a lot of consumers had. And we also know they look at non-traditional real-time data. Things like job postings on recruitment websites, salary trends, the number of open positions, all of those were likely flashing red.
Which brings us to the political side of this. The sources really suggest the Fed's so-called independence is more of an outer shell than a reality.
I think that's a fair way to put it.
Yeah.
It has the structure of a private institution, but its power is, fundamentally public. The highest body, the Federal Reserve Board, has 7 members, all appointed by the president.
But they have those long 14-year terms to try and insulate them.
They do, but the real power is with the Federal Open Market Committee, the FOMC, 12 voting members. And the chair, Jerome Powell, he only gets 1 of those 12 votes.
Just one.
Just 1. And what 2025 really showed wasn't just healthy debate inside the Fed. It was the rise of what the sources call strong division, deep political friction, made worse by all the external attacks from figures like Trump.
And you had these factions form inside, right? The doves, the hawks.
Exactly. Yeah, the extreme doves who were all for cutting, the extreme hawks who wanted to hold or even hike, and then a swing middle. And the thing is, you can always find data to support your narrative. The doves would point to weak employment. The hawks would point to inflation still being above 2%.
And the doves won out, which puts Powell in a really tough spot as his term ends in June 2026.
It's the classic political trap. He's either going to be blamed for a recession if he holds rates too long, or for runaway inflation if he cuts too much. The fact that there's such strong division, it really suggests he's lost a lot of that soft power. A chair's real influence isn't his one vote, it's his ability to build consensus. That's clearly eroding.
And all that instability at the Fed just spilled right into the markets. Let's shift there to volatility. It feels like the market's reaction to political news showed the Fed had kind of lost control of the narrative.
Absolutely. The year was defined by it. I mean, things were calm until April 2nd when President Trump announced these widespread tariff plans.
Yeah.
And it triggered instant widespread panic.
How bad did it get?
In just a few weeks, from mid-February to early April, the market plunged 19%. It was a huge investment pitfall. And it was global. The Hang Seng Tech Index in Hong Kong dropped over 17% in a single day.
Wow.
Yeah. And investors who panicked and sold got hit twice. They took the massive loss, and then they missed the explosive rally that came right after.
And that rebound was just as fast, wasn't it?
Almost instantaneous. The moment Trump backed off on the most extreme China tariffs and negotiations started, the market just exploded. The DOW jumped almost 8%, NASDAQ over 12% in one day. It shows you the key financial data of 2025 wasn't just corporate earnings, it was political headlines.
Which brings us to maybe the biggest theme of the year, this K-shaped economy. GDP grew over 2%, which sounds healthy, but when you look under the hood, it's incredibly narrow.
It's shocking when you break it down.
Yeah.
So 2% of U.S. GDP is roughly $500 billion. The total AI-related capital spending, all the hyperscalers building data centers, buying chips, was over $400 billion.
So basically the entire U.S. economy outside of the AI ecosystem
Was essentially flat. It barely grew at all.
That's the stagnation. That's the bottom leg of the K, while the AI winners are shooting up on the top leg.
Exactly. That's why the S&P 500, which is weighted to those big winners, was up 16%. But 37% of the stocks in it were actually down for the year. If you look at the equal weight S&P index, it was only up 10%. That gap tells the whole story.
And while we're on the K-shape, we have to touch on the affordability crisis. Housing especially. It just keeps getting worse for that bottom leg.
The sources are very clear on this. It's a supply problem, not a demand problem. The real issues are local. Restrictive zoning laws, complicated permitting, these crazy impact fees that can add 10 to 15% to the cost of a new home. The federal government really isn't equipped to solve that.
Okay, so let's turn to that engine, the top arm of the KAI. The market is betting everything on this. But what are the risks that could actually derail this whole cycle?
The demand is real, no question. I mean, NVIDIA's revenue grew 60%.
Yeah.
But there are two huge constraints emerging. The first one is structural. It's the power supply.
The actual electricity.
The actual electricity.
Yeah.
U.S. electrical demand growth has tripled to 3% a year. That requires 125 terawatt hours of new power. To put that in perspective, that's like adding the entire state of California's consumption to the grid.
And you can't just build that overnight.
No, it takes 2 to 3 years, best case. And delays are already happening. If the hyperscalers can't get the power, they have to slow down their chip orders, and that whole growth story starts to reverse.
Okay, so that's the structural risk. What about the second one? You said it was intellectual.
Right. This one is more fundamental. The whole boom is based on the assumption that large language models, LLMs, have to get bigger and bigger to reach artificial general intelligence, AGI. More scale means more chips.
But what if that's not true?
What if we're hitting a point of diminishing returns? That's the minority opinion that's starting to grow. People pointed to the release of ChatGPT 5 in August and said, it's not really that much better than version 4. If that idea gains traction, that we need new breakthroughs, not just bigger models, then the demand for all that hardware could just plateau.
That's a huge risk. But there's another quieter threat brewing in private credit. It's ballooned from, what, $2 trillion to $3 trillion since 2020?
And the key word there is quiet. The biggest risk is its opacity. Back in 2008, mortgage data was public. It was complex, but you could see it. With private credit, there's no central database. If it starts to collapse, it's going to come as a complete surprise to the public.
We saw some warning signs, though.
We did. 2 big fraud cases in 2025. Tricolor and First Brands, They involved misrepresenting collateral. And they just signal that there are these systemic weaknesses, this willingness to cheat, that will get exposed in a big way when the next recession finally hits.
Let's zoom out to the global picture for a minute. With the Fed cutting rates, what's happening in China?
Well, the Fed cuts are narrowing the interest rate gap between the U.S. and China. That takes pressure off their currency, the RMB, and that gives the People's Bank of China a lot more room to maneuver to use their own monetary policy to deal with their domestic challenges.
And one of those challenges is driving them into this low interest rate era. Why are their rates falling so consistently?
It's a mix of things. Cyclically, they have low inflation and weak consumption. So if they don't cut nominal rates, their real interest rates stay high, which just encourages more saving instead of spending. but it's also structural.
Oh.
They need cheap long-term money for what they call high-quality development, EVs, AI, chip manufacturing. Those are industries that need huge upfront investment and have long payoff cycles. That, plus things like demographic changes and slowing urbanization, it all just naturally pushes long-term rates down.
And we have to mention two of the big investment landmines from 2025. Bitcoin hitting $126,000 and then crashing.
Oh, that was a textbook lesson. The surge was fueled by massive leverage.
Yeah.
When that tariff shock hit the market, it triggered a cascade of margin calls, forced liquidations, a total liquidity vacuum. It proved, once and for all, that it behaves like a high-risk tech stock, not some kind of safe haven.
And gold had a big surprising drop, too.
It did. Gold fell 6% in one day in October, the biggest drop in years. That was driven by a sudden hope for less geopolitical conflict plus a stronger dollar. It really showed that gold's value was tied more to the narrative of global tension than anything else.
So what does this all mean? As we look ahead to 2026, what are the big takeaways?
I think there are two core risks that define the path forward. First is stubborn inflation. Even with the Fed cutting, it might just stick around near 3%. That means we could easily be looking at a mild stagflation environment. Low growth, but with stubbornly high inflation. And second is that threat from private credit. If the Fed keeps policy easy, it just encourages more and more leverage in those opaque markets. We know the weaknesses are there. When the next recession hits, those weaknesses will be exposed, and it could trigger a pretty significant credit crisis.
That sounds like a tough road ahead, but it also kind of confirms that every year is hard paradox. Markets somehow navigate these things. I guess our focus should be on understanding these mechanisms you've laid out, not trying to make perfect predictions.
Exactly. And it should lead us to ask a more provocative question for the future. Given all the political pressure we're seeing on central banks around the world, should we just expect that their independence is going to keep eroding, making all our future economic cycles even more volatile and tied to election cycles?
That is a crucial question to keep in mind. Thank you for joining us on this deep dive. And just a reminder for everyone listening, this content is for educational purposes only. It's not... Full in-depth analysis, you're welcome to join our Deep Value Club membership or subscribe to us on Apple and Spotify podcasts. The channel is Deep Value Investing. We'll see you next time.